The Fed speak is maybe not surprising. We know that the central bank needs to put the clamp and tamp down inflation. But what does this mean for markets now? Are markets now in a position where they can say, hey, we know what's going to come, we can now rally ahead, or do we think it's still a headwind?
Good morning. Thanks for having me. Good to see you. I think the pivot that everybody's focused on is the Fed pivot, and that's the wrong pivot. The right pivot is inflation pivot, and we've already had it, right? Inflation topped at 9% on the CPI. Now we're at 7.7 or whatever, and it surprised to the downside and likely will continue to do that for a little while. You know, when we have inflation declines, if you go back and look at the charts, they happen rather quickly. So the Fed is lagging on the way up. They'll be lagging on the way down. My expectation and the good news that came out of their last release was that they're going to slow the pace of rate hikes. They may go a little higher, they said. They may do it for a little longer. But slowing the pace of rate hikes means the data is going to matter more. And so if we continue to see sort of a slide down in inflation levels, then they can talk tough all they want. But the thing I really care about is I look at 5-year forward inflation expectations. Those are at 2.29 right now. Fed's target's 2. So M2 is at the slowest growth rate in 30 years. I think they've done plenty of work here. It's filtering through the system. So the tough talk will continue. That's guidance. That's a policy tool. They may see recession as a policy tool, but it's a soft landing if we get one, and I'm just not worried about it.
So David, I mean, to your point, I mean, first of all, it sounds like you are calling the peak in inflation. You don't think that inflation is going to come back in 2023. But you also mentioned this idea here that the forward expectations for inflation are relatively low. And by the way, they've been creeping down for a while now. How do you respond to those who say that those inflation indicators, tips, break-evens, and whatnot, are not accurate reflectors of inflation right now because of the dislocations in the fixed income market?
I mean, maybe that's the case, but there are 100 different indicators, and they all point the same direction, which is that inflation is going to be falling, not rising. And you've got momentum to the downside. Good inflation is deflating. You know, we're seeing what's happening in the housing market. It takes a while for shelter to roll over. And that was the only thing really holding that inflation report up last time because it was up 80 basis points or something. So I think the evidence is there if you really dig through. So I get the narratives, but, you know, if you dig into the data and you really do your homework, and you look at history, I mean, we're just in a period where you're going to see some of this disinflation. Now, that's not what the Fed really cares about. What the Fed really cares about is the softening in the labor market. So the market movers coming up are going to be the labor statistics. And if you look at recent jobless claim numbers, they've really softened rather quickly. So we'll get an employment report. Hopefully that'll be a little softer. But I think the pivot has happened. It's happened in inflation. That's why the market has rallied strongly, and it had been overbought. We needed a day like yesterday to clear out some of the excess, but I think there's stability here. And as long as the dollar stays soft and, you know, 10-year stays below 4 and the inflation expectation index creeps back towards the Fed's target, then we get the Santa rally.